It is Thursday the 17th of January and we're seeing some pretty nasty moves in stock indexes today. Are we finally going to break out of these start of the year ranges and establish a trend that could last us to March or April? It's starting to look that way. We're not quite there yet, but we've seen some pretty nasty moves overnight. Hong Kong's Seng index fell 3.7%, to close pretty close to the lows of October 2022. Their GDP missed estimates. I really don't think it missed it very much, but the market took it pretty badly. I think the economy grew by 5.2%. The market was expecting 5.3%, which is not much of a miss, but it was a little bit of a trigger for some selling. South Korea's KOSPI was also down 2.5%. In Australia, the ASX got hit, still in a correction for that one. And the Nikkei's had a second day of a bit of a pullback on a market. Really, the Nikkei's been doing really well. So we can really only put that down to a pullback. But that has spilled over pretty nasty selling in the FTSE. And the DAX not looking quite so happy either. However, we do, I have to say, have some bullish patterns still in US stock indexes. So we'll take a look at them. First of all, though, I'd like to talk about the dollar because this move has really prompted a big move in the Aussie dollar. Now, let's look at this on the weekly. When we were looking at this Aussie dollar at the kind of start of the year to see if we see a pullback and then we are going to continue higher, we were looking at these weekly moving averages to be support and potentially a 50% retrace of this lovely big 5-wave rally that we had back to this swing low here around 0.0657. However, we're underneath it today. We're also underneath this 200 moving average. For me, potentially, this is kind of support. I think if we can find a buyer at these previous lows and we can close back above at least this 50% level at 0.657 and maybe back above that daily 20 moving average, maybe this route is done. However, if I measure the swings, which you know I'm a big fan of, so I measure this first high to low, you can see that actually this says to get to this equal measured move level, we have further to fall to 0.65, which likely lines up, I think, with this 61.8 level. It does. So 0.65 would be where we have an equal corrective swing. And as you know, when you draw an equal measured move pattern like this, and you drop underneath this 61.8 level, closing back above it would be a bullish reversal. So as long as we can say, as long as we stay underneath 0.6592, we are likely in this Aussie on any bounces to continue lower down to 0.65, which is where our measured move support is. And then if we bounce from there and cannot recover these daily and weekly moving averages, then continue lower. So nasty rollover. And again, yesterday or at the start of the week, we were looking at further to fall in this Kiwi dollar and this previous low in the 200-day moving average. We haven't got there yet in the Kiwi. And if we look at where our measured move projection level is in this Kiwi, that's also where we are at 0.068. So any bounces in the Kiwi and the Aussie have further to fall. And that means, unfortunately, let's take a look at this euro because the sideways range that we had been in. So we started the year with a really nasty drop, dollar strength, and then we'd been in this sideways range between 1.08 and 1.097. We had flat daily moving averages and we were going sideways. For me, we've broken down it today. Are we potentially coming into some support from this daily 200 moving average? Potentially we are, but if we do the same thing here, we measure our swings, we measure this first high to low, project it from the top of this nice 3-wave correction, we have got a little bit further to fall before we hit our first support in the euro, 1.083, and this is also where the daily 200 is. But if we do the equal measured move in this euro dollar, then we've got further to fall also down here to 1.075. Where is this dollar strength coming from? I really do think it's the market is starting to pare back their bets on Federal Reserve rate cuts in March. We're seeing some of that in the options market. People are hedging their bonds. hedging against the prospect of a half-point March rate cut. But I think markets really are starting to see that potentially, especially with unless we see kind of some, I just don't see the Fed cutting rates yet in March. Now, if we go to war and everything goes to hell, that could happen. But at the moment, it's not happening. And one of the biggest things that could be a driver is oil. And remember, this is the weekly chart of crude oil. Potentially, we have done a big head and shoulders pattern here, and if we break this weekly 200 moving average, which we have gone sideways above for the last 6 weeks, if we were to close this Sunday underneath it, which we have not managed to do really for more than a year, then our next downside is here at 0.54. This has been a level where I thought we could see potentially a bigger bounce, but it's not happening at the moment. And it's quite interesting, isn't it, when you consider everything that's going on in the Red Sea and the Middle East, that oil prices are in retreat. But I think perhaps Chinese economic weakness and this broader kind of risk-off sentiment is what's driving it. So is this, for no breakout from this really nasty sideways range at the moment, but certainly on the daily, all of these moving averages are bearish. And if we break down from this consolidation, first place I'm going to look is a retest of these lows down here around 67, but potentially if we break that and solidly, then we continue lower to 54.11. If we take a look at gold and silver, we were looking at the potential of a bigger bounce in gold. Here it hasn't happened. We've dropped all the way. We were looking after breaking above these daily moving averages. We were looking for a shallow pullback and to continue higher. In fact, I think we're in a bigger, again, corrective pattern here in gold. We've done 3 waves down, 3 waves up, and I think that we're in that final third swing, hopefully, of that correction. This makes it easy because we can measure then this high to low in gold, project it from here and say, if we break this daily 50 moving average, which was really good support when we tried it in December, if we to close underneath it in these previous lows around 2015, 2016, we are going to continue lower down to 1981, and potentially we could do a bigger 3-wave correction back to 1914. But we really are teetering on key support here in gold this morning, and how this closes will tell us a lot. That means we had more downside in silver. I thought if we could turn up from here, I was only going to be bullish if we could recover 23.28, which has been such strong resistance. This is an hourly chart, but if we look at it on the daily and put regular candles on, you can see that this was such an important resistance level for silver at 23.28. We weren't going anywhere unless we could recover it, and it hasn't happened, unfortunately. So we'll take all this off because this is not. We're likely to retest the lows. And again, commodities and silver has made very nice 3-wave patterns. This was a very nice switch. So we're looking for 3 waves going the other way. If we measure, again, mathematical relationships, this was an important 61.8 level at 22.5. And if we break and close at new lows, we are likely to come all the way back down to retest 21.2 again in silver. So we really need a higher low and turn up again. I was hoping, but hope is not a very good trading strategy, but I was looking for potentially a higher low and a turn higher back to retest this 23.28 level, and maybe some kind of inverted head and shoulders pattern here would be a good look if we don't retest these lows. Otherwise, I think, bulls will need to be looking for a double bottom here around 22.47. So I'm being patient with this one, but it's a pretty choppy start to the year, isn't it? So that's how I'm seeing silver in let's take a look at these stock indexes, which have had such nasty hits. First of all, though, I'm going to look at the US 10-year note, because when we were looking at this rejection, first off, if we zoom out here, this 10-year rally, If we measure our fibs from the highs post-COVID 2020 to the lows that we made here in October, when the Fed pivoted or hinted at a pivot, this really lovely rally took us exactly back to this 236 fib. 236 fib for me in Fibonacci terms are really important kind of bullish and bearish reversal levels, and this is exactly where we failed in the US 10-year. And sometimes, you know, when you first time back to these big levels, you expect them to fail initially. And then if you just do some nice sideways consolidation, find some support and turn up again and have another go, you can break through. And for me, the important bearish reversal level, in other words, are we going to do a bigger bottoming pattern, is the 236 fib going the other way. So if we go down to the lower time frame, we look at this on a daily from the low that we made in October, the 236 fib coming back the other way is really important. And that is where we found support. The first week of January, first Friday, was the low here at 111.17.5. At the moment, as we head into the open, we're underneath this level. If we close underneath this, we are going to see more losses. We are more likely to come next to this 38.2 level, potentially in a bigger ABC that's at 110. And quite often, you know, bonds go first and stocks follow. So I'm not one of these kind of they're an opposite. So I'm watching this 111 level and 110.13, I think, next if this fails. If we look at it on a 4-hour, you can see we've kind of lost our moving average support. And if we look at it on the hourly, haven't made a new low yet. So there is potential, you know, that we could still recover it here, but it's looking a little bit tough. Okay, so in the UK, we had a really nasty reversal today on these. When we closed yesterday, we were holding really kind of interesting daily moving averages here. The daily 50, we were sideways at the 200 moving average. It would be in a really good place to pull back and hold on support, but a really nasty drop, and it looks to me like we're headed back to the bottom of the range in this FTSE. I'm going to go back to the weekly, because potentially we are headed back to these kind of weekly range lows on the weekly 200 moving average, and this has just been first drop and then some nasty consolidation, and we are about to potentially enter another leg lower here. So I don't like how we've lost these weekly moving averages. Now I know we've got a while till Sunday night, but potentially we are. If we look at this from the low that we made again in March 2020 post-COVID, we had a lovely 5-wave rally, and it is a very normal in a correction to come back to the previous wave 4, which is these lows here, and down towards that 6,800 level. And so it wouldn't look too weird if we had a swing low, a correction, and then one more swing low. It wouldn't mean, you know, that the world's ending, but it would be quite a normal place to come back to in a correction in this FTSE. 7,600 and 800. Now, let's see how we go. When we set up a trend normally in January, it does seasonally tend to last to kind of March, April. So don't be surprised if that's happening. Now, at the moment, I said in the US indexes, we're at a pretty bullish pattern level. This is the E-mini S&P. From the high that we made here on the 11th of January, we've made an equal measured move correction. Potentially, we could call this a little bit of a channel, a bullish flag. We had 5 waves up, 3 waves back. We're back at the bottom of this previous swing low. This, you know, if you're bullish, this is kind of one of those first places you're going to look for a bigger move. However, if this turns into a bigger route today, then I'm going to measure from the high we made at the end of December to this low. And if we're going to look for that bigger 3-wave correction here in the S&P, we haven't quite got to our equal measured move level. So if I measure from this low to the high, project it from here. Now, when you make these 3-wave corrections, equal is quite common, but quite often the third leg is 61.8 of the first leg. So if I measure from this high to low, project it from here, that 61.8 level is a bit lower here at 47.52. And so for me, if we lose this daily 20 moving average, if we go below this equal measured move level, 47.51, 47.46, that's the kind of zone where I'm going to be looking for next for this to find support. But you know, it is one of those levels we're on as we head into the open. You know, potentially we could say, well, we've done 5 ways down here, and this equal measure move level is a level where we would expect the market to attempt a bounce. But if we don't, and if we continue lower, that's where I'm looking for. Now, what would confirm a bullish reversal? Well, again, if I put these measured swings on, okay, high to low, project it from this high. So 47.71 is our equal measured move level. If we bounce from here and we close back above this 61.8 level on a back test, that's at 47.96, that would be quite bullish. That would say back to the top of this little flag or channel that we're in. So 47.96.25 today would be what I would want to see on a close, on a 4-hour close, if we're going back up to the top of this range and continuing higher in this S&P. If we look at the NASDAQ, we've done similar. You know, this is an hourly chart, but really on the 4-hour as well. This is choppy overlapping sideways. This is the corrective price action. Now, could we, with this 5-wave rally, fall back lower to the middle of this range, this previous wave 4, maybe 50% of this whole swing? Yes, we could. But at the moment, you know, we are sitting on pretty interesting support, aren't we? If we draw this trend line from this low to this low, we've had one of those third touch false breakdowns. So we need to see this breakdown for real if we're going to see that bigger 3-wave correction and come back to the 50% level at 16,698. So a little bit choppy sideways in this NASDAQ at the moment, but that is kind of key support, and this is where we go if we break down. If not, you know, because this is a bit of a triangle, we're going to look for a retest. Again, we've got 1, 2, 3 touches, false breakout, and we stayed within the range. So third touch, false breakdown, we've stayed between the range. Which way are we going to break out of here? Honestly, flip a coin. I don't know. I think though that if we look at the big drop that we had from the 28th of December to that first week of January low on the Friday the 5th, that we're more likely to do a bigger ABC, and so I lean towards lower. I measure from this high to low, and that's going to be my target this way, which means for me that we are more likely, I think, to break down. And if we do 16,543 is more likely where we end up in a bigger 3-wave correction, and potentially equal measured move even lower at 16,226. So that's what I'm looking for in the NASDAQ. Now the DAX has been pretty, since the start of the year, this is the DAX weekly, really since the start of December, we've been in a little bit of a sideways correction. And I have to say that for some time, really, this DAX has been, if we look at the high, for example, we made in 2021, then here in 2023, we made a marginal new high, went sideways, and then did a bigger pullback. We're kind of doing that again. We've gotten above these highs, we've made a marginal new high, and we're going a little bit sideways choppy. Now, as you know how I feel about this 236 fib level, if I look at the most recent swing from the central bank kind of pivot zone in October, the support that we held last week on the 1st of January was this 236 fib level, and we're underneath it today. If we look at it on the daily, you can see. And that does kind of point to a bigger correction. Now, I want to know which the bigger 236 fib the market is looking at. So when I lose this first 236, what I tend to do is move it down to this bigger one and say, okay, if we stay underneath this 236 fib level and this previous high here, we are in fact likely to continue lower, and the next 236 fib support is down here where the daily 50 is at this 15,778 level. And if I put that short term back on here, you can see that that lines up also with a textbook 50% retrace of this low to high. So this 15,775 level for me, if we stay underneath 16,443, is where we're likely to continue to in the DAX today. Now, that's how I'm looking at that one. Some of these other indexes I've been looking for example, the let's take a look at this ASX. So I was looking for a bigger correction to start in the ASX. We were at pretty big deal highs all the way back, you know, to 2021, this sideways range here. Really kind of tough level around 7,600 for the Australian Stock Exchange. And we said if we fell underneath 74.31, which is this 236 fib retrace level, we're likely to come back to this 38.2 next and further. And if I, again, instead of measuring from this most recent swing, do both these swings, potentially we've got a bounce level here, 73.54. However, the moving averages, certainly on the weekly, this now becomes quite a bigger bearish reversal. So maybe we get a bounce here, but I definitely think this 38.2 and we are headed lower in this ASX from here. So I'm not saying never, but 73.54, if we are likely to see a bounce before continuing lower, we're getting pretty close to it. The Toronto Stock Exchange, look how bullish this is compared to some of the others we have been looking at. Now this is another one which made a marginal new high. When I measure from this high to low, I was looking for higher, but I said we couldn't rule out to start the year a back test of this 61.8 level at 20,500. We had this kind of breakout here. And although we've been going sideways, if everything is headed lower, we have been teetering as we start the year on this daily 20 moving average. Underneath this, if we close underneath this daily 20 moving average, which is at 28.40, I think we will see this bigger pullback retest of our breakout level around 20,500 and 20,526 on a close is that back test of that fib level. So yeah, if everything turns into a little bit of a shakeout to start the year, that's going to be key support for me in the Toronto Stock Exchange. Now, if I measure from this swing low, put it from this low, you can see that's also where our 236 fib retrace level is in the Toronto Stock Exchange as well, 20,562. So that's how these markets are looking today. Sometimes when this happens and we get a nasty risk off moves, we can see selling. It's not good. It's not bullish for Bitcoin. Let's put it this way. If Bitcoin doesn't fall with everything else, that kind of makes it look pretty good for people, I think, as a hedge. But it's certainly going to be a little bit of a drag. Okay, good luck. Let me know if there's anything you're looking at that you'd like me to look